So thanks a lot to the organizers for inviting me, and especially thanks to Jonathan. So it's my second time presenting here. The first time was great, and so I hope that this time it's going to be going as well. So please interrupt me as soon as you want, or as often as you want for questions and so on. So this is called sovereign bond purchases and rollover crisis. And I'm particularly happy to present this here in front of this audience because this is all about central banking, right? I mean, the title maybe is not as explicit as it should, but it is about sovereign bond purchases by the central bank, okay? And the case in point that I would like you to have in mind during the whole talk, and the one I'm going to use, including in the very small empirical analysis I'm going to do, is the case of a country like Italy that issues sovereign bonds and that has a central bank like the ECB that has substantial program of asset purchases of its sovereign bonds. Okay. So why is it that I want to study this question in this paper? If you think of this program that are now very ubiquitous, not just in Europe but in many countries, you can start from the conventional theory of why they might happen in reality, and that conventional theory, the one that most people have in mind, is a sort of lender of last resort type of argument. So there is the idea that a self-fulfilling debt crisis or something that can happen in the background. If the central bank is concerned about this, then the central bank can commit to stand ready to buy the debt at fairly high prices if they think that investors are going to coordinate on some bad equilibrium. What is a bad equilibrium? Well, it's an equilibrium where it's a self-fulfilling debt crisis. So something like investors think that a country like Italy is going to default, so they're going to ask for a very high risk premium on the debt. So it's very expensive for Italy to roll over its debt, and so because of that price, they will default on their debt because it's too expensive to roll over the debt. So that's a self-fulfilling debt crisis. If the central bank stands ready to buy debt at high prices, if that's the case, then investors know that there is no reason to expect this default to happen, and so the bad equilibrium will never happen in equilibrium, right? So that's the common interpretation of the Draghi moment of 2012, the whatever it takes moment, where he said that the ECB was ready to do whatever it takes to preserve the euro, and of course it was enough in the sense that the ECB did not have to purchase any bonds at that time in order to calm down asset markets. Okay, so that's the conventional theory. Now, there is a difference between the conventional theory and what we see in practice, because what we see in practice are substantial purchases. Okay, so in this theory here that you have that dates back from Calvo, for example, the central bank can stand ready to buy the debt, but you should never see it happen because investors have no reason to coordinate on the default equilibrium, and so the bad equilibrium does not happen, and so you don't need to do any purchases in equilibrium. What you see in practice are very, very substantial purchases. Okay, so I'm not just talking about something that's slightly different from zero. I'm talking from very large asset purchases programs in Europe. Okay, so what you have on this graph here is the change in the share of holdings in Italian public debt, depending on different investors. Okay, and there are the blue ones and the gray ones are the normal ones, the private investors, and the red one is the ECB. So what do you see? You see that in 2015, the ECB started to buy an incredibly high amount of Italian public debts, so much that they basically became the only net purchases of Italian debt. Okay, so if you look at the stock holdings since here 2008, what you see is that since 2015, Italy has issued more than 750 billions of public debt, and all of it was absorbed by the ECB. Nothing of this extra issuance was held by private investors. Okay, so that's already a difference from the conventional theory because you see something that's extremely large. Now, at the same time, the fact that these programs are so large raises questions about their potential costs and maybe some perverse effects. Okay, and there is very little research on that, but there is some criticism, informal criticism in policy circles and in conferences that mostly focuses on what I'm going to call in that talk the price discovery process. And that's simply the idea that sovereign debt is a risky asset like any other risky asset. And so private investors have some incentives to acquire information on the risk of default of these bonds, and then they trade on it that incorporates this information into prices. Prices are revealed that information, and that's something that, in general, we should welcome. Okay, well, the fact that the ECB is buying such large amount of debt is probably distorting some of these incentives, and one of the questions of this paper is going to ask how is that the case exactly now. Hannu Lustig put that idea very well in a conference at the New York Fed, I think in October 2022, by saying that central bankers should maybe consider the possibility that the interventions, because of their extreme scale, may not improve the functioning of bond markets, but in fact may actively hamper price discovery. Okay, so that's a potential cost that is usually not directly studied in the literature. So with that motivation in mind, what is it that I'm going to do? I'm going to do what I think is the natural theoretical next step here, which is trying to understand these issues by building some very stylized asset pricing model with endogenous information acquisition, such that these things here, these incentives to acquire information, put them into prices, are present. But it's going to be an asset pricing model that is concerned with sovereign debt, because this asset purchase is all about sovereign debt. Okay, so there's going to be a country like Italy that's going to issue some debt that is risky, and they're going to face some rollover crisis risks. That's the idea, that there is some self-fulfilling default risk in the background that may be harmful and that the central bank could want to prevent. And then we're going to study the effect of asset purchases in equilibrium by the central bank in that environment. Okay. Now, if I just say this, you could expect that the answer, the result of the paper would be that there is a benefit of doing asset purchases, and that's to get rid of the rollover crisis risk. And then there is a cost in terms of information acquisition and price discovery. And so there is a trade-off, and you want to be in between the two, and that would be the end of the story. Okay, but that would be not super interesting. That would be quite straightforward, and that's actually not where I'm going to go. Okay, so what I want to argue today and propose as a theoretical possibility, and I'm going to give you some empirical exploratory analysis to show that this is consistent with what I'm going to propose. What I'm going to propose is that this hampering of price discovery that you have here, the idea that asset purchasing programs distort incentives to acquire information by private investors, is actually not a problem, a bug of this program, but might actually be a feature of them. And so in that sense, the trade-off is not going to be between these two things. It's going to be more of a story of, by purchasing a lot of sovereign bonds, the central bank is going to discourage price discovery, information acquisition, and that in itself is going to be the key for preventing rollover crisis. Okay, so that's why I'm going to say that preventing information acquisition, hampering price discovery, is going to be a feature of this program and not a bug. Okay, so let me give you an intuition for why that's the case, and at the same time give you a preview of the results and how I'm going to show you that during this talk. The intuition for this result is that in this kind of setup, and I'm going to show you, in more detail why that's the case, but the fact of information acquisition by private investors, so think of, for example, hedge funds that invest some resources into trying to understand the future fiscal capacity for repaying the debt of a country like Italy. Okay, so that's an effort. You need to put some resources into it, but then once you do it, you get a more precise picture of the fiscal capacity of the country, and so you're able to price that debt more accurately, and so you can trade on that new information and maybe take advantage of other investors that didn't put the effort into this information acquisition. Okay, so that idea of information acquisition by private investors in this type of models is going to have two contrasting effects. The first one, and that's the effect that a country that issues debt should welcome, it's the idea that this is going to reduce the risk premium on average. Okay, so if you have a lot of investors like these hedge funds, these mutual funds, or so on, that put a lot of effort into trying to understand your fiscal capacity, your repayment capacity of that debt, they're going to be more certain of the payoffs of investing into your sovereign bonds. And so they're naturally going to ask for a smaller risk premium, right? And that's a good thing for you, because that means it's going to be easier for you to issue debt. It's going to be cheaper, and you're going to be able to finance more expenditures, and you should be welcoming this. So you should encourage this information acquisition, at least through this effect. Now, the second type of effect, and that's going to be why sometimes asset purchases can help, is that by having a lot of information acquisition, your bond prices are also more sensitive to news about your repayment capacity, right? So if a lot of investors are putting efforts into trying to understand, I don't know, your inflation experience, for example, then when there is this news about the future inflation, then your bond prices are going to move more because more traders are trading about this news. So that means you're going to have two things on average. You're going to have a smaller risk premium, and so a higher price on average, but also a higher volatility of bond prices with respect to news. And the fact that these bonds are subject to some rollover crisis, something that I'm going to highlight in a minute, is very important for that because it's the volatility on the downside that can trigger this rollover crisis. Is there a question? Okay. So that's why information acquisition has some, two contrasting effects, and so that's why price discovery is not always a thing you should try to encourage to its maximum. Now, the second step in the argument is to say that indeed asset purchases, I'm going to show you why in the talk, but by the central bank are going to reduce the incentives to acquire information. Okay, so the quote and the criticisms I show you in the previous slides, at least according to this model, are right in the sense that by doing very large asset purchases, then it's true that the central banks are distorting the incentives in a negative way to acquire information by private investors. This is true. What's more surprising is that in terms of welfare, this can be beneficial. Okay, and the idea is that by preventing too much volatility, especially on the downside, you can eliminate the risk of a rollover crisis, which is something that everyone wants to get rid of because it's just a pure self-fulfilling crisis that's completely dominated by the other equilibrium that does not feature self-fulfilling default. So by doing asset purchases, you can reduce information acquisition by so much that you can eliminate the risk of rollover crisis, even though the risk premium can be higher on average because of the first effect. And that's something that in terms of welfare can be beneficial. So that's why I was telling you before that I'm going to turn the argument on its head that price discovery is not, a problem for these asset purchases programs. It's actually the feature of such program. Reducing price discovery is exactly what you want to do in such an environment, and something that really differs from the traditional argument for asset purchases that I showed you at the beginning is that it might require substantial equilibrium purchases. So it's not about the fact that you stand ready to buy the debt in case of a problem. It's the fact that you buy a lot of the debt that reduces price discovery. And so you need to implement these purchases in equilibrium. Okay, so that's why. Yes.
We have a question from Itamar.
Yeah, please.
Hi, Paul. One question. Would you say that maybe you get to that later on, but is the limit of what you're saying YCC, yield curve control? That's the opposite of price discovery is price control. So if you fix the yield curve, you get rid of all price discovery. The risk premium will be there somewhere, but it's kind the limit of the policy that fixes the problem if there is one.
Yes, yes. So I never thought about this, but I think you're entirely right. That's a good point. Which is that if you do, so much asset purchases in the sense that I'm going to do asset purchases up to the point where it's exactly the price I want or the yield I want, then you get exactly the same thing, which is I completely reduce price discovery. There is no incentive at all to incorporate any information into bond prices because I know what the price is going to be tomorrow. It's set by the central bank, and so you do get rid of the problem. Now, in the paper. In an extension of the paper, and I'm not sure I'm going to have time to talk about it today, but there is also the idea that it's costly for the central bank to have so much bonds on its balance sheet because you're still exposed to some risk. And so I'm going to assume that if there is a quadratic cost of holding this debt, because these are risky debt, then you don't want to go up to the point where you completely fix the yield. You want to go up to the point where you eliminate self-fulfilling defaults, but you stop here, and then you let the market take the rest. That's the idea. Okay. But you're right. If it's completely costless to hold these bonds, then you do want to do yield curve control in a sense. I think that's right. Yeah. Thank you. I think there is another question.
Yes, from Daniel Nathan.
Hi, Paul. Yeah, I wasn't. I'm not so familiar with this literature, but I thought that the fact that you actually see asset purchases might be because the ECB might be just doing some cheap talk, and the market doesn't believe it. Have to show, and or they do it and they see how much they intervened, and the market thinks, well, that's not enough. They're not really committed to it, so we have to intervene more. And that's what you see a lot of asset purchases, not necessarily because of the channels that you're talking about.
So yes, I think you're entirely right. You could have other theories for why you want to do asset purchases, and I think the one you have in mind is correct. One interpretation actually of that graph here is that in 2015 the ECB said, I'm going to intervene. The market did not believe it would be enough, and so that's why they had to do it. But if you see the scale of this asset purchases right now, I think it's pretty clear that they would do what is needed to enforce what they call like anti-fragmentation measures, and still the scale of asset purchases has been so large for a lot of years. So I'm not saying this is the only challenge, but I do want to make the point that people have in mind the idea that this is going to distort information acquisition. I'm going to show you that this is true, and then I'm proposing a theory for why this is actually helping you achieve your goals. But there could be other channels that also help you achieve your goals. That's entirely fair. Yeah.
All right. Thank you.
Thanks a lot for the question. So if there is nothing more here, I'm going to move on. And just tell you very quickly about the last part of the paper, which I'm pretty sure we'll not have time to talk about today, which is the idea that, once, of course, that's the second step. If I'm a country like Italy and I know that the ECB is going to intervene to prevent this rollover crisis happening by disincentivizing information acquisition, then that creates some perverse effects on the side of the issuance, right? It means that it's going to be, I know basically that the ECB is going to bail me out, and that creates a moral hazard problem. And so then I'm going to issue even more bonds than before. And I'm going to force the ECB to run a very inflated balance sheet, and that's also going to lead me to excessive indebtedness. And I'm going to show some graph at the end if I have time about this. But that's the next logical step in the argument. The ECB buys a lot of bonds. There is basically no information incorporated into prices, and Italy issues even more to take advantage of these compressed yields. Yeah. Okay. So let me skip the literature, or just tell you very quickly something about the literature. Maybe is that I'm not the first one, of course, to put forward the idea that sometimes information acquisition or is not a good thing. And Gary Gordon, my colleague at Yale, has been a forceful voice in that literature. And so in a sense, this is the same insight here. It's just applied to sovereign bonds because these assets are also subject to runs. And then I'm adding a layer, which is to say that one way to prevent this excessive information acquisition is to actually do asset purchases by central bank. Okay. In terms of the literature on self-fulfilling sovereign defaults, there is a large literature on it. Let me just mention that I'm going to use off-the-shelf model from Cole and Kehoe that basically models this kind of rollover crisis risk that I think are very, very relevant in the case of what we saw in Italy in 2012 and 2015. But of course, if there is more question on the literature, I'm happy to go back to it and talk about any paper. Okay, so let me present to you the model very, not briefly, but in details. But what I propose to do, because of the time constraint, is maybe to spend more time on the graphs that explain the intuitions than the equations. But again, if you want to talk more about the deep equations, I'm also happy to show you the slides on that. Okay. So just to fix ideas, what is going to be the setup? It's going to be as stylized as possible. Okay, so I'm going to do a lot of simplifying assumptions, and then I'm going to relax these assumptions in the appendix and show with numerical methods that you get the same results. That's the plan here. So I'm going to just show you the very simple model, and then we can talk also about the extensions at the end, of course. But I think all of the intuition is inside this very simple model. So you have a small open economy that I'm going to refer to as Italy during the talk. There is 3 periods, time 1, time 2, and time 3. Time 1, the country wants to finance some expenditures, and then they need to borrow. And then at time 2 and 3, they need to roll over that debt because they want to smooth consumption. Okay. There is 2 types of default risk. The first is a completely exogenous default, and that's going to be denoted by this probability here that I'm going to call delta. Okay. So let's think of something like, it's a political risk. There is always a risk that for political reason, I don't know, some populist party get into power or something, and they decide to default. Okay, that's the first default risk. So debt is never risk-free. There's always a risk that the country defaults. And then at time 2, when the refinancing decision is made, then you can have a rollover crisis that I'm going to highlight in a second, coming from the Cole and Kehoe seminal paper in 2000. And that risk, I'm going to denote it with the red letter lambda here. Okay, so this lambda is going to be a sunspot, and I'm going to show you that in a second. So these are the 2 types of default risk. This one you basically cannot get rid of because it's a risk inherent to the country. This one you can possibly get rid of if you manage to put yourself in a region where rollover crises are not possible, and that's going to be the idea. Okay, so here time 2 and time 3, it's basically going to be off-the-shelf Cole and Kehoe, and everything that's going to be important here is going to happen at time 1. I'm just going to do this to separate the decisions and to make things clear enough. what happens at time 1? You have a continuum of mean variance investors. These are the private investors, hedge funds that trade the country's debt. And that's the key of the paper. They can acquire information about this delta. Okay, so again, delta is some uncertain number. If you're a hedge fund and you have enough money, you can put some resources and put a team of analysts to try to understand what is this delta exactly. You're going to receive a signal about what this delta is, and so you're going to have more precise information about the default risk of the country, and so you're going to be able to trade more aggressively on that signal. Okay, how does that work? In the model, it's going to be a heterogeneous fixed cost of acquiring information, and that's going to be parameterized by this letter gamma here, and I'm going to come back to that. What is the central bank doing? It can decide to purchase sovereign bonds at market prices, so not directly distorting asset market prices, but purchasing sovereign bond and asset prices at market prices. But by doing this, this is going to spill over the information acquisition decision of private investors ex ante, and so that's why these asset purchases are going to have an impact on the equilibrium price. Okay, so that's the setup. Slight more details on what's happening at time 2 and 3. This is again just a simplified version of the Cole and Keyhoe mechanism. This is actually taken directly from the Aguiar and Amador textbook on sovereign debt. Okay, so the government arrived at time 2 and 3. They have some endowments. They're going to issue some short-term bonds. There are no contingents, or really sovereign debt. They do this because they want to smooth consumption, but they also enter with some stock of debt B1 that they issued in the previous period. Okay, and then, as I told you before, they can exogenously default with probability delta, but they also need to roll over the debt. Okay, so how does that work? Well, they decide how much they want to roll over, so they auction some debt B2. That's the debt they're going to carry from time 2 to time 3, and then upon seeing the result of the auction, they decide whether they want to repay B1 or not. Okay, that's the idea. So what's happening really in that type of model? Well, you're a country, you enter time 2, you have some debt B1, that's here, okay? And then you know what the traders are going to offer for your bonds B2, okay? And so if traders expect you not to default, they're going to offer some price schedule. And so you're going to have a value function, that's the blue line here, that for each amount B2 that you decide to issue at time 2, gives you your utility level at time 2. Okay, and so what do you want to do? You want to issue up to the point where you maximize your utility function, and that's the point that's here. Okay. Now there is a second possibility, which is that investors believe that you're going to default in period 2. If that's the case, well, they're going to offer you a price of 0 on your bond. That's the 0 that's here. So whatever B2 you issue, you're going to get 0 because investors believe you're going to default. Okay, and that's going to give you this utility function here, which is the red line. Now, of course, if you are on the red line, the only way to maximize your welfare is to issue 0. There is no point in issuing debt if the price is 0. Okay, so you have the choice between actually issuing 0, and then you will be here, or defaulting, and then that gives you some utility function VD. If this point is above VD, then this is not an equilibrium. Okay, investors expect you to default. If they do, you're going to issue 0 but not default, so it's not an equilibrium. Okay, and so that's why you get a unique equilibrium right here. The interesting case, of course, is when you get multiplicity. So what is this case? It's when the blue line is exactly as before. But this point that's here, so remember, this is the utility you get at time 2 by not issuing any new bonds, but still repaying your previous bonds. If that point is below the value you get by defaulting, then you're going to default. It's valuable to default if investors expect you to default. And that's the two equilibria you can have, okay? How is that going to work? Well, it's going to work when this point is above or below this the value, and so there's going to be a threshold that depends on B1. So that's the idea of rollover risk. If I issue too much debt in the previous period, then it's possible to have a rollover crisis next period. It's possible because if investors believe that I'm going to default, then it's going to be valuable for me to default. Okay, so multiplicity is going to arise when B1 is higher than some threshold B1 star that we're going to keep in red. Okay, and when that's the case, you need an equilibrium selection device. I'm going to use the most, maybe not natural, but the easiest. End up in this equilibrium, which means you get a rollover crisis. Investors expect you to default, so you default. With probability 1 minus lambda, investors expect you not to default, and so you can issue B2 and B here. Now, what you see from this graph, and think it's intuitive, is that this equilibrium here dominates completely this one, right? The self-fulfilling default equilibrium is just, pure a loss of value, and so you should always try to be here. So if you can avoid this situation and avoid the sunspot, then you're going to improve welfare immediately. Okay, so that's the Cohen-Kihou mechanism. What we just need to remember from this is that there is a threshold B1 star, that you can characterize it, but there is a threshold B1 star. If I issue too much debt in the previous period, then I'm going to face a sunspot self-fulfilling default in the next period. Okay, so if that's clear. Is the supply of bonds. So how much bonds are going to be issued by the country at time one, given the pricing of investors. What I'm going to do here, and again, that's one of the very simplifying assumptions I'm going to do, and then it's relaxed later in the appendix, is to assume a linear and downward sloping demand for funds. Okay, so how much bonds are issued in period one? It's going to be this constant B1 minus a linear function of the price. Okay, so that's the idea, is that I need to finance some expenditure. Okay, so if the price is very low on my bonds, people expect me to default with high probability in the future, I need to issue more bonds because I really need to finance my expenditures. Okay, that's the idea. Okay, it's very mechanical, but it's just to take care of the supply part of the function of the model and get everything nice and tractable. And then in the appendix and in the end of the slides, I do everything with other type of supply, strategic issuance and other stuff like this, and you get exactly the same result, except that you cannot get it in closed forms. Okay, so that's the idea: linear supply of bonds. Okay. Now, what are the investors doing? The investors care about one thing, which is whether they're going to get their money back by issuing new bonds. I'm going to call this repayment indicator chi. Okay, so it's 1 if the country is repaying, and it's 0 if the country is defaulting. And again, remember, there is two ways of defaulting. There is the political risk delta, and then if B1 is higher than B1 star, and now everyone observes that number B1, so everyone knows when B1 is higher than the threshold, then you're also going to get default with probability lambda, because if you get into the rollover crisis risk, the country is going to default with this probability coming from the sunspot. Okay, and you have a continuum of investors, mean variance ones, right? So this is the utility function they have. That's the payoff. That's how much they need to pay for the bonds, and that's the penalty they get because they invest into risky assets. So sigma square here is going to be the risk aversion of the investors. Why do I use mean variance investors? Because you get this very simple formula. Okay, so how much are you going to invest into these bonds? It's just going to be the expectation of the payoff. Okay, so that's basically 1 minus the probability of default minus the price divided by the risk aversion time variance of the payoff. Okay, and that's going to be helpful for the rest. Now, the second key ingredient of the model is information acquisition. Okay, and so that you need that if you want to talk about price discovery and informativeness of prices and so on. So investors start by being identical in the sense that they have all the same prior over delta. So remember, delta is the exogenous probability of default of the country. So the prior is delta 0. It's a number between 0 and 1, and they have some precision tau over that prior. But each investor can decide or not to pay some fixed cost before the issuance to try to acquire some information about that delta. Okay, and the way it's going to work is that you have investors I, which is a number between 0 and 1, can pay that amount, I squared divided by 2 gamma squared, before issuance to get that information. Okay, and so the idea here is that investor 0, the first investor, has basically no cost of acquiring information, so they're always going to do it, and investor 1 has a higher cost of issuing information. Okay, and they all are ranked by their cost of issuing information. What happens if you pay that cost? So you do your research and you get some signal. Everyone's going to get the same signal amongst the one that pay the fixed costs, and I'm going to call that signal S1, and it can either take a negative value or the positive value. Okay, and that's just how much you update your prior over delta. Okay, so if you pay that fixed cost to acquire information about the country, then your posterior is going to be 1 minus delta 0 plus the signal. So if you receive minus S, that's negative news. It means the probability of default is higher than what you thought we. Not only do you update your level of your expected payoff, you also have a higher precision now. Okay, so you are going to be able to trade more aggressively because you're going to be able to trade with less risk, basically by acquiring information. That's the good side, right, of information acquisition. In the idea that if all the investors acquire information, they're all going to be less risk averse effectively, and so they're going to require a lower risk premium, which is good for my bonds. Okay, and then I'm going to denote by psi the share of informed investors. Okay, so that's the idea. Because you have heterogeneous costs, right? The investor 0 is always acquiring information because it's free. Investor 1 is very expensive to acquire information, so they're basically not going to acquire information. There is one investor in between 0 and 1. That's the marginal one. That's basically the one that's indifferent between acquiring information or no. That's going to be the marginal one. Everyone before him is acquiring information. That's going to be the share of informed investors. And everyone after him is not acquiring information. And that's the share of uninformed investor. Okay. So that's basically all you need to understand these two phases of information here. And so now we can get into the intuition for why asset purchases can help and why information acquisition is not always a good thing in that particular setup with a sovereign bond that can be subject to rollover crisis. So what is the intuition? If you take any very normal type of asset, imagine some type of equity or something, and you plot its price as a function of psi. So remember, psi is the share of informed investors. When psi is high, it means a larger share of investors are acquiring information. What's happening? Well, if these investors are getting a positive signal, the price is going to increase by a lot with psi. There are two effects for why that's the case. The first is that you get a lot of investors that trade on positive news. That's good for the price. And at the same time, you get a lot of investors that trade with lower risk aversion because they have a higher precision on their information. And both of these things are going in the same direction and increase the price. If you get a negative signal, then you get a price that decreases in that share of psi, right? But the decrease is less aggressive than the increase you get in the positive news, because this time the two effects are going in the opposite direction. Okay, we get negative news, and that's bad for the price. We lower the price, but at the same time we also trade with lower uncertainty, and so we require a smaller risk premium, which increases the price. So that's why this Q1 plus S is increasing faster than Q1 minus S is decreasing, which means that on average, the average price Q1, the one that's expected for each psi, is increasing in psi. So that's the good thing about information acquisition. Lower risk premium, higher price, and that's something you want to encourage if you're trying to issue debt for like the higher price possible.
Paul?
Yes.
We have a question from Eliezer Bornstein.
Yeah, hi. So, I don't know, intuitively, I would expect that in a setting which is more ambiguous regarding the fundamentals, we would see asset prices more volatile, or their variance would be more bigger. And it seems like here the opposite is true, because I know a fraction of the economy is oblivious of what happens to the default probability, and so they don't act upon that. So, I mean, does that fit how we think of, reality in that sense?
Yeah. So I think there are yeah, I think it's a good point. There are two things happening, right? One thing is like for a given psi. So let's say you're here. What is the volatility of prices for a given psi? And I think here that's the idea we have in mind, which is when there is more uncertainty, then this volatility is going to be higher, right? Then if you fix that level of volatility, so in a sense, in that mode, it means if you fix the volatility between the signals and you increase psi, then you get higher volatility around the higher prices. That's the feature of the model. So I think that like two kind of uncertainty that we might have in mind for this. And I think the reason, I mean, the intuition for why it is going in this direction is that if you really think of the cases where no one acquires information and people have no idea about oops, sorry, I think I clicked on something.
No, it's okay.
No? Okay, sorry, my bad. If you get to the case where no one is acquiring information, right? Then when news arrive, no one should trade on it, and so the price should not move. And so that's the idea for why here you have no volatility. Of course, it's a case that would never happen, but that's the intuition for why when you go to the left, you get lower volatility.
Okay, great.
Does that make sense? Yeah.
Yeah, thank you.
Paul, I may have one question about this figure, just to be sure I understood. So is it possible to say that from this figure, the more the sentiment, the market sentiment about this share is positive, and then the more the price will increase? Or
Okay, that's a good question. Sorry, I should have mentioned that. This psi here, right? So the share of informed investors, it's going to be an equilibrium object. And I'm going to assume like full rational expectations so people know what the psi is going to be.
Okay.
So there is no uncertainty about the psi in this.
I see.
In the sense that every agent in the model knows the parameters, so they understand the cost function of every other traders. And so they are able to compute in their head what's going to be the equilibrium psi because they know who's going to be the marginal investor.
Okay. Thank you.
And then, natural next step would be to say, there is no way the central bank can know what this psi is. So there should be uncertainty around it. And so what should you do if that's the case? And that's, something I would need to think about.
Yes, or even, thresholds of uncertainty, not necessarily,
Yeah, no, that's a good question. I will need to think about it. That's yeah, we can talk more about this. Here it's going to be like psi is known to everyone, including the central bank. What can the central bank do to change that psi? But that's a natural question. Yeah.
We have another.
Question. Yeah.
Yes, from
Hi.
Cohen.
Hi, Paul. Can you draw in this graph the riskless asset?
Yes, very
equivalent,
good point.
Let's say equivalent asset with which is riskless.
Yeah, so that's a good question. So you're right. Here, this works only because there is a risk, right? This is because we think the country can default in the future, and so we want to understand that probability of default. But if you think of a country where there is no probability of default, I don't know, maybe that's the case for Germany, then there is no incentive to acquire information. And so, basically, I don't know if you see my cursor, but it's going to be flat here.
Yes.
It's going to be flat here, flat above, completely flat, but at the same time, in equilibrium, psi is going to be 0 because no one is going to acquire information. But even if you do acquire information, it's not going to change anything.
Okay, thank you.
Yeah, so actually, that's a very good point. At least for that model, the one I'm proposing here, it matters that you do asset purchases on bonds that are risky. Right? The channel is not going to work if you buy bonds that are riskless. That's a feature of the model. Yeah. Okay. Now, so that's what happened with any asset. Now, the thing here, and the thing that's interesting is that this asset is a sovereign bond. And so it's possible that you run into self-fulfilling default in the future. And then remember what I showed you in the previous slide. Let me go back a second. Here, there is a threshold, B1 star, such that if B1 is higher than B1 star, then you get into that problem. And another way of saying this is that given that supply function, B1 is higher than B1 star, it's the same thing as saying Q1 is lower than some Q1 star threshold, okay? And so that's what you have here. If the price drops below threshold Q star, then you face rollover risk, which means that there is a discontinuity here. Suddenly at time 2, there is a probability lambda that the country defaults because of self-fulfilling expectations. And that creates this discontinuity you see here, where the price suddenly, when you get negative news, drops because now you need to price in the fact that the country might default with probability lambda just because of rollover crisis, okay? And that feeds back into the average price because the expected price is the average between Q1 plus S and Q1 minus S, okay? So that's the idea for what happens with a risky bond price. That's the intuition I give you at the beginning. You want a higher price on average. That's good for you. But at the same time, you want to avoid this volatility on the downside. That's what creates rollover crisis. Now, that's really the intuition for the whole mechanism in the paper, because you can see from this graph, basically, guess what the welfare implications are. If you're able to move that psi, then you can see from this graph that if you're here, just on the right of the threshold, then you want to move it to the left of the threshold. But you don't want to move it up to, to the point where no one acquires information. You want to be here, basically. That's the sweet spot. That's where you get, a good risk premium, like a low risk premium, and at the same time, you don't face rollover crisis. That's what you want. So you want some amount of volatility, but not so much that you get into sunspot problems. That's the idea of the model. Okay, so let me skip the equations because that's basically just what I said. The equilibrium price, has a risk premium that decreases in the share of informed agents, but its sensitivity to information increases in the share of informed agents. Okay, but the problem is that rollover crises happen when prices are too low. So you care about the downside risk. You just don't care only about the average price. So what is this sign? You need to understand what is in equilibrium. That's what I was telling Jonathan. Here is going to be fully rational equilibrium, full information on that front. You decide whether you want to acquire information based on expected utility. And so, the marginal investor is the one that equates the two. So the marginal investor is the one that has an expected utility if it acquires information minus the cost of acquiring information equal to the expected utility of not acquiring any information. Okay, and so that's what you get in equilibrium, right? So you draw the expected utility of an investor if it acquires information and the expected utility of an investor that does not acquire information for each side, and you find the one where the two lines cross. That's the marginal investor, and that's the psi that you have in equilibrium. What matters in that model really is whether that psi in equilibrium is higher or lower than psi s. So remember what psi s is? Psi s is the share of informed investors, such that even if you get the negative news, you still don't get rollover crisis. Okay, that's really the threshold. If psi is higher than psi s, that's what you have here, then you get rollover crisis possible at time 2. You get rollover crisis if you get negative news, so you get a price that's lower than the threshold, and then you get the sunspot in the next period. So that's why you get discontinuity after the threshold. Okay. What is the analytical characterization of this? Well, it's going to depend on gamma. Why does it depend on gamma? Because gamma is the one that parameterizes the cost of acquiring information. So that's fairly intuitive. When gamma is high, it's relatively inexpensive to acquire information. So you're going to get a lot of agents that decide to acquire information in the sense that the psi in equilibrium is going to be very close to 1. And that's when you get excessive information production, because rollover crises are going to happen with probability lambda divided by 2. So remember, 1/2 because of a negative signal, and then lambda from the sunspots. And then you can show that when gamma is larger than this number, then that's when you get a rollover crisis. So going back to Jonathan's question, everyone knows the parameters of the model, right? The gamma, the psi s, the taus, and so on. And so everyone can compute this and know when or not there is going to be excessive information production and what exactly is going to be the psi in equilibrium. Okay, so that's the intuition now. The one thing that actually matters for the rest of the paper is to notice that here there is a B1. Okay, so what is B1? Remember, it's the coefficient that is in the supply function of bonds in period 1. And so the idea here is that by changing the supply of bonds that private market participants have to absorb, you're going to change that condition on whether you are on to the left or to the right of the threshold. Okay, that's going to be the idea for asset purchases. It's the fact that by taking some of the risky asset supply outside of the balance sheet of private investors, you're going to change their incentives to acquire information. Okay, so how does that work? Let me skip that and just tell you why B1 matters in that case. So the idea, it's actually, I found that recently, but there is a paper by Joel Perez in 2010 that makes that point in the stock market. But the idea that, when you reduce the supply of some assets, you're going to change the risk sharing incentives. Okay, and here that's what happens. So why B1? Two effects. First, there is less risk to hold in the aggregate. Okay, so the number of bonds the number of bonds that we need to absorb on our balance sheet as private investors is smaller than before. Okay, so all of us are going to reduce our positions in equilibrium. At the same time, I'm going to show you that's the line that's below, but the idea is that informed investors, so the ones that do pay the fixed cost, are more sensitive to supply chains than uninformed investors. And you can look at this by just looking at the individual expected position. So what is the expected position before getting the signal of an investor that pays the fixed cost of acquiring information? It has the B1 inside, right? Because it depends on the full supply of bonds. And it's multiplied by this tau prime here, which is the precision you get on your new information. The expected position of someone that's uninformed is very similar. You have the B1 here, and you have the tau here. But the point of acquiring information is to get a higher tau prime than the previous tau, right? So here, what multiplies the B1 on the left is a larger number than what multiplies the B1 on the right, okay? So your individual expected position, when you reduce B1, are going to be more sensitive than the ones of the informed. And at the same time, the fixed cost of acquiring information are always the same because it's a fixed cost. Okay, so that's the idea for why you reduce information acquisition. Here, it's because there is less risk to hold in aggregate, and so there is less incentive to try to understand how much risk you're actually taking by buying these assets. Okay. So what happens if you're on the case on the left? Okay, so psi is lower than psi s, which means there is some amount of information acquisition.
Paul?
Yeah, sorry.
Sorry to interrupt. We have a question from Eliezer. Borenstein.
Yeah. So when you say that risk is being taken out of the economy, you refer to the fact that it is now held by the government, right?
So in this case, it's carried by the central bank.
Bank.
Because in the case I have in mind, I have the ECB in Italy. It's not exactly the same thing, right?
Okay.
But you're right. So that's the next step of the question. If you are in a country where you can consolidate the two because the central bank and the treasury are the same thing, and the investors know that if the central bank lose money, they're going to be taxed, then it washes out in equilibrium. So you need a way to go away from the irrelevance of asset purchases in all cases.
That was where I was heading, but I wanted to say that it might still be the case that the identity of those that are informed is not as, I mean, in your example, maybe it's exogenous or random, or I'm not sure what determines if you're informed or not, but in reality, it might be the case that the informed ones are also the ones that bear the tax costs of losses to the government more than the others, and so it still might be operative in reality.
Yeah, so that's completely fair. That's completely true. So because of the time, I didn't mention that in the beginning. But yes, you need something that goes away from Sergeant Wallace irrelevance of asset purchases first. Because if you completely put it in, then it's irrelevant, because whether the central bank buys assets or no, I'm still having the same risk, and so I should have the same incentives to acquire information about that risk, right? So you need an assumption that says these persons that I'm mentioning, the ones that acquire information, are at least not fully going to be the ones bearing the cost of a loss if that happens. Why do I think that's relevant? Well, because I think the ones that usually bear the cost are households, and they are typically not the one acquiring information. So if you think of the case I have in mind, these are hedge funds or stuff like this, international hedge funds, and so I think that's why the assumptions works here. But you're right. You need two things. You need breaking Sergeant Wallace, and then you need information acquisition.
Yeah, and if I may, another question. I know it's probably difficult, but in principle, is there a way to see, or do we know from empirics that when central banks buy assets, investors actually reduce information acquisition?
Yeah, thank you for that question. So two answers. The first is that I have a very suggestive and first pass of the empirical evidence to show that that's the case. But the plan for the paper is to have something like more robust and fully empirical about this. And so if there is any suggestion, I'm very much open to it. But let me show you one way to go at this problem, which is to say, okay, so the key prediction, as you said, is that if the central bank buys assets, you're going to reduce the incentives to acquire information. Okay, so it's always hard to observe information acquisition and data, obviously, but one way to do it is to look at analyst forecast. Okay, and what is the correspondent of information acquisition in the model is to say the forecasts are going to be less precise on average when there is less information acquisition. That's something that seems reasonable. That's what happens in the model. If you ask these agents their forecast about the macroeconomic fundamentals of Italy, you should see it to be less precise after asset purchases than before asset purchases. That's the idea behind less information acquisition, and that's what you see in the data. So I take analyst consensus forecast on GDP inflation, industrial production for Italy. I look at the data between 2010 and 2023. I'm going to split the sample in two. So basically before information acquisition, 2015, after information acquisition, 2015, 2023. And I'm going to take out COVID, obviously, because there the forecast is just unrelated to asset purchases. And I'm going to look at the variance of analyst forecast error. So that's exactly what the precision of information is, right?
So just to see if I understand, in principle, like in an ideal setting, we would like to have another, let's say, another hypothetical Italy in this period where there were no asset purchases, right? Okay, so
that's what you need. But the reason you cannot get it is that the ECB by law is obliged to buy bonds from all countries at the same time. Right. So if they buy bonds to save Italy, because Italy is the one subject to rollover crisis, they have to also buy bonds from Germany, from Spain, and from France, because there's this idea of you cannot help one country. That would be monetary financing, and so you need to help all of them. So that's why what you have in mind is even more complicated, and so that's why I did this with forecasters. But I do want to do something more thorough in the near future. So any suggestion is welcome on that. Yeah.
Okay, thanks.
I see another question.
So it's Nimrod again. So if I understand you, it's maybe better to look at, let's say, not Germany, but other countries rather than Italy, which doesn't have recession, let's say, in this year, because maybe the recession itself caused, some uncertainty and lowering the acquisition. And if it's also in France, and France didn't has, I don't know what's exactly happened. It should be interesting to see.
Yeah, no, I agree with you. And so that's a fair concern. That's why I also looked at the variance in yields. So because you're right? If, of course, you do asset purchases in bad time. And so bad times are when things are going wrong. And so that's also why maybe forecasts are less precise. Just to make sure that I don't think that's what's driving it, I'm looking at the variance in the yields. Okay, so if the story is about good times versus bad time, you should see higher variance of forecast errors after 2015, but also higher variance of yields after 2015 because bad news and stuff. And here you see the opposite. So if you look at the variance of yields, after 2015 than before, you see that it's much lower during asset purchases than before. So it's not just driven by the state of the economy being in a recession versus not. But you're right. I should do the cross section one. Yeah.
Okay.
But thanks. I'm going to speed up a little bit because I'm very much out of time. But that's the idea for the mechanism. Information acquisition can be excessive. If you buy asset purchases, it's true that you're going to reduce information acquisition. And so you can basically get rid of rollover crisis if you buy enough bonds. Okay, so that's the idea. If you buy enough bonds, you're going to go to the left of the threshold, and then you're going to guarantee that even if bad news happen, the number of bonds issued is still above the threshold, and so there is no risk of a sunspot. So information acquisition is lower, but you are to the left of the threshold, so you completely avoid self-fulfilling default. Now, what I want to highlight is that this is not an off-equilibrium outcome. Okay, so this is not the Calvo story of I expect the central bank to intervene, so I don't coordinate on the bad equilibrium, and so I don't see asset purchases. You need to see not only asset purchases, but there is a minimum size, which is, if you do small number of asset purchases, it's just going to move the equilibrium side to the left. But what you want to do with the equilibrium side is actually go to the left of the threshold. Okay, so that requires a minimum size of asset purchases that is given by this number here. That depends on the parameters of the model, but just to say, it's not enough equilibrium outcome. And so if the equilibrium side is very much to the right of the threshold, you do need very substantial purchases to be able to implement that equilibrium. And that's just what you have here on this picture, right? So if the equilibrium side is here, you want to the right of the threshold, you need to do enough asset purchases to go to the left of the threshold. And how does that work? Well, you get the effect I was mentioning with supply here, which is that the blue line, which is the expected utility of investors if they acquire information, is going to shift to downward more than the red line. And so that's why the point where they cross is actually going to the left. And that's because the expected position of investors that acquire information is more sensitive to supply changes than the expected position of investor that does not acquire information. That's the idea here. Now, once we have this and we understand this, welfare is completely straightforward. And so I'm just going to give you the graph because I'm out of time. But you see, it's always the same thing, right, in the model, which is what is the welfare of the country? Well, you want to issue debt with the lower price possible. That's what you want because with the higher price possible. Sorry, that's what you want because that's how you finance your expenditure, and that's how you avoid rollover crisis at the same time. And what is the shape of the welfare function depending on the share of investor acquiring information? It's really the same thing as the shape of the price, right? So at first it increases with the number of agents acquire information because you get a lower risk premium on your debt, and that's good. And then when you cross the threshold where the price of the debt is so low when there is negative news that you face rollover crisis, then you get a big drop downward in your expected utility because suddenly there is a new risk of default in the future that's completely unrelated to your fiscal fundamentals, and so you would like to get rid of this. Okay, so in terms of welfare, again, you want to be here, and so that's why you do asset purchases to move to the left. Okay, that's how you get asset purchases that are larger than that are welfare improving, is that you need them to be larger than the minimum size I showed you before. Otherwise, imagine you're here in equilibrium and you do asset purchases that are not big enough, you're going to move here. That's even worse than before, right? So that's the idea for the minimum side of it. There is some kind of non-linear or discontinuous welfare effects of asset purchases because there is a discontinuous effect where there is a threshold, okay? So let me just mention very quickly before concluding that what I showed you as very, very simplifying assumption. So I gave you a linear supply of funds. You can get rid of that by assuming that the country needs to raise some amount of money. You can also do the full case where the country actually does optimal issuance. So they take care, they understand the supply function, how much they want to issue, and still you get kind of the same thing. Costly asset purchases I mentioned in the beginning. So you can assume that it's costly for the central bank to hold these assets. And then you get the same type of result because of discontinuity. And then there is a moral hazard case that maybe I want to show you in a second. And that's the idea that, that the case on the right here is when, if the orange case is if I issue my bonds, that's my welfare function. If I issue bonds and I don't take into account that the central bank is gonna buy my assets, okay, I would issue someplace here. If I anticipate that the central bank is going to buy some of my bonds to reduce information acquisition, then I'm going to issue much more. Okay. The interesting case is the one on the left, and that's the case where if I don't take into account that the central bank is going to intervene, I would issue here. So I would not face rollover crisis. That's the left of the threshold. But if I take into account that the central bank is going to intervene, then I want to issue to the right. So I'm going to issue so much debt, right, that without a central bank intervention, I would not even, consider being in the case of self-fulfilling debt crisis. But because of the intervention, the moral hazard effect is so large, then suddenly I issued way more debt. Okay, that's the idea, and maybe that's what's happening with Italy right now. Okay, so let me just conclude, maybe not repeating everything I said. I think what matters is the second point here, which is it might be a feature of these programs rather than a bug. To hamper price informativeness, and the idea is that it can help you avoid rollover crisis. And then I also mentioned, but if there is any, suggestion or idea on how to implement an empirical analysis that's a bit more robust to understand the effect of asset purchases on the price informativeness of sovereign bonds, then I would be very happy to hear them. But thank you very much for the comment, and very open to a discussion right now.
Thank you very much, Paul, for your fantastic presentation and model and explanations. So if we have any questions, please raise your hand. I just have one question. So I think you did not take this into account, but maybe this should be taken into account. Is that the central bank is not. Okay, we are independent, and the sovereign bond issuer is also independent, and but there are discussions. Central banks. Some central banks could issue a recommendation about the sovereign debt. The state can also do what he wants or discuss with the central bank. We know that in some countries it could have happened that some states discussed with the central bank in order to convince the central bank to there are linkages between the state and the central bank which may not affect the central bank independence but could maybe change what could affect the model and the pricing and how the central bank will buy the debt that will be issued by the state. So I think this should be taken into account, or maybe like a kind of warning. I don't know how, but
No, so that's interesting. So I think what you say really applies very strongly to the extension I had about moral hazard. So the idea that really these two things are, it's a game between these two agents that basically don't talk to each other and just maximize.
I think it depends on each state. Maybe there you have some. I assume I don't know very well this issue, but I assume that in countries like Finland, Sweden, Nordic countries, there is maybe a strong independence between the state and the central bank. But maybe in countries more in the south, you would have more linkage discussions.
Look, I agree. I think
maybe you can take also some texts or recommendations from central banks about sovereign debt issuance. and recommendations about debt and what happened after the recommendation. Maybe, I don't know.
Okay,
but there is something.
Let me give you I agree with. I mean, I agree basically, and that's a good suggestion. Let me give you two quick answer maybe.
Mm-hmm.
I mean, not answer, more comments. So I think in one way you can understand the insight of the paper as being, there is a way of reducing information acquisition. I mean, information acquisition can be excessive. One way to lower it is to have an actor that's big enough to intervene and take away from private balance sheets a large share enough of bonds. Okay. Now, it becomes more complicated when this actor is a central bank because, as you said, there is an interaction between the two. But then I think you're right, and I think that's what we see in Europe, in the sense that the ECB, does a lot of asset purchases for a lot of countries, but at the same time they issue very strong guidance about, reforms, structural reforms that need to be put in place, and so on. And I think that's one way to get rid of the rollover crisis problem, and at the same time tame the moral hazard issue. Doing the two at the same time. One is more controversial than the other, but yes, I agree with you. Basically, we should talk more about this. Yeah.
Yes, I think it could be a very interesting feature, especially after the debate, a very big debate, maybe related to MMT and stuff like that. But yes, do we have any additional questions from the audience? Yes, Eliezer.
Yeah, well, I basically mainly wanted just to say thank you for the great presentation. That's really interesting. But since I have already risen my hand, so I'll ask another thing. Yeah, well, I was wondering about the process of investors learning about delta in the model. How exactly does it look in reality? So I was wondering whether there's some institutional micro literature discussing how do investors build their assessments regarding the strength of a specific country. How long does it take? Because if it's a matter of a day or two or a year or two, could matter for the empirical strategy of how to try to identify it. So is there anything that we know about that? That's basically the question.
Yeah. So thank you. That's a great point. So my understanding of how it looks is, you work in a hedge fund or something like this, and you have some, depending on the hedge fund, you have some sophisticated model of how debt should be priced, or something like a debt sustainability analysis. And so you plug in the macro fundamentals of the country, you put your forecast about import, exports, taxes, and so on, and then you run them all, and it gives you something about the path of debt and how it's going to evolve, and whether it's going to pass the threshold where it will be likely that the country would default. That's my understanding of it. Regarding the timeline, that's a great point. I don't know, and mostly I don't know how we translate into the empirical analysis. That's a good point. Yeah.
Right. Thanks again.
Thank you very much, Eliezer, for your question. So, do we have any additional questions about the paper? Okay. So I will just ask one question. Yes, one question about the model. You started the model by describing a small open economy, and then after I did not see the linkage between the rest of the world, and maybe I missed something. But I do think that it could be very important to clarify. So do you have an explanation or something? Because small open economy for us in Israel is very important, because we are a clear small open economy, maybe too small, maybe too economy, I don't know, but we are. And then it should be very interesting to hear you about that.
Yeah, thank you. Good point. Actually, it's linked to the Sargent and Wallace point I was mentioning before. The idea here is that it's a small open economy in the sense of you issue bonds that can be bought by investors that are outside the country. That's all I meant by that. And the reason I need this is because, again, if you assume that all investors are how do you say that, the domestic ones, right? Then you get back to the problem that if the central bank buys bonds from these investors, the investors should realize that if the country defaults, the losses of the central bank are going to be recouped by taxing these same investors, which are the households or the domestic banks and so on. And so there is no real effects of buying asset purchases. So the reason it works here is because some of these investors are outside the country and at least expect not to be taxed to recoup the loss of the central bank in the case of a default. That's what I mean here by small open economy. Yeah.
I see.
I should clarify this language. It's not really small open economy in the sense of the international literature. It's more.
Yes, it's just an open economy. Yeah, just an open economy.
Yeah, exactly.
Yeah, okay. And one other question, if there is no question from the audience, I will enjoy this to ask what would be, so, okay, you have this paper, you have this model, you have all the tests that you are doing by relaxing or not some assumptions. What is the recommendation? Look, you are a policymaker and you want to do something with your paper. You say, look, we have to implement such programs that could lead to excessive indebtedness, but this excessive indebtedness would avoid rollover crisis. This is the bottom line.
Okay, so I would be more cautious, but that you're the policymaker, so maybe you should then tell me. But my interpretation of the model would be to say, okay, we do these programs and the very large in scale, they seem to work in practice. Okay, but there is a lot of criticism about what these programs imply in terms of price discovery, information acquisition. Okay, and the point of the paper at first to say, let's take this seriously. Is that true? Is that a theoretical property of these models, or is it not true? The first answer is yes, it's true. Okay, and then it's building an argument to say, but that's not necessarily a problem. Okay, so I view it more as a way of defending what this asset purchases program do, than really that's how much you want to that's how much debt you need to buy, right? Mm-hmm. Then of course it comes with limitations, and the moral hazard one is a good one, right? And then I think here, but then you would need to be a little more serious model to do a recommendation like this. But you need to do something like what you had in mind before, which is, okay, now there is a moral hazard problem. What is the way to build some kind of I don't know how you call that, but some kind of mechanism that limits the moral hazard problem while taking care of the safe, fulfilling default risk at the same time? And that's a very interesting open question for research, but I'm not there yet. But yeah.
But I think this could be also your empirical research question related to this paper. I mean, you take one example, as you have done for Italia, but maybe another case, and then just if you are able to evaluate, the correct quantity. I would not see optimal quantity, because for us it's very difficult to, but maybe the desirable quantity of asset purchases that would be able to switch the state of desirability.
Yeah.
I mean, quantify empirically. You take 1-2 years, or when it happens, maybe take another country. I think it could be very, very interesting related to the model, what the model gives in terms of how it quantifies this state, this desirable state.
Yeah, good point. So I would my intuition, but again, I would need to do the empirical analysis, is that I think it would be possible to give a number in the sense of how much asset purchases do you need to do to reduce price informativeness by this amount? That's an elasticity that I think you can empirically estimate. Now, going from this to how much you want to reduce price informativeness, and so how much asset purchases you need to do, I think there you need a calibrated model, and that's more complicated and
yeah,
so
yeah.
on. And that's not my strong suit, but you know that better than me.
But also defining empirically what is price informativeness is not easy.
No, especially for sovereign bonds. So for equity, it's easier. Usually, I think in the data, it's something like how much price movements forecast future cash flows. For sovereign bonds, it's more complicated because you don't observe default.
Yes.
So you don't have variation in cash flows. So you need something more creative, and I'm working on it right now. Yeah. Any ideas? By the way. Yeah.
Eliezer have another question.
No, just because you asked to be creative, so I'm gonna throw everything that comes to my mind, even if it doesn't make a lot of sense. So just to see if I'm correct, so when the central bank purchases assets, it will reduce, in principle, the variance of the payoff of the bond, because it will eliminate the risk of a self-fulfilling crisis. So we would see a tightening of the uncertainty regarding the value of the bond, something like that.
Yes.
Right?
Yeah,
but conditional and not having a crisis, I think we would get a widening of that variance, because agents are less informed. They acquire less information following the bond purchase, and therefore, given that conditional, again, and the possibility that a crisis does not occur, the variance should be now, regarding the payoff, the variance should be larger. Is that true?
But again, again, in the mall, what you get is that, when you're here, so very low information acquisition, you run here, the variance, even if you don't have self-fulfilling crisis, is lower, right? The average price is lower, but the variance is also lower, at least in the way variance is defined in that model, which is, how much prices move with your arrival of new information.
Okay, so this might be a dead end, but I was basically trying to say that I think there's a paper that I've seen by Valentin Haddad, I think.
Yeah, okay.
Where he, using auction data, tries to infer what the market thinks about the distribution of the fundamental. Maybe that wasn't regarding sovereign bonds. Maybe it was about other assets, but maybe that could be some way of inferring something.
Thank you. So I will have a look at the paper. Actually, the idea I had in mind to try to understand whether price informativeness is high or lower after asset purchases was to try to infer from option data or something else the probability of default by the market, and then you try to regress price movements today on future probability of defaults. And the idea is that if price informativeness is very low, price movements today are basically unrelated to future news about default, and that's what the model would predict. But you would need to get to that probability of default that's inferred from option prices. But I will have a look at the paper you mentioned. That's a great idea. Thank you.
Thank you very much, Eliezer. Just for French people, it's Valentin Haddad or Haddad. Valentin, it's something else. We will end this seminar on this. Thank you very much, Paul, for this excellent seminar and excellent paper.
Thank you so much, and again, thank you again for the invitation. It's always a pleasure to present in front of the audience, and thanks a lot for the feedback. You will see it incorporated in the next version very soon.
With pleasure. It was also a pleasure for us. Thank you very much. Have a nice day.
Thank you, everyone.
Bye-bye.